So, what is the deal with the market right now? Is it a rocket ship fueled by a genuine AI revolution, or is it a ticking time bomb built on a passive investing bubble? That's the billion-dollar question we're going to tackle today. And the answer, well, it could change everything. All right, before we dive in, just a quick heads up. What you're about to see is a special re-edit of a really fascinating debate from the Sip&Talk podcast, and it's brought to you by our friends at Micky. We've basically boiled down all the key insights to give you the absolute core of this massive argument in just a few minutes. So let's get into it. To really set the stage, let's look at a real-world portfolio that just perfectly captures this whole debate. Okay, imagine an investor, right? They're 50% in an S&P 500 fund like VOO, but then they add another 15% in TSMC and another 15% in a semiconductor fund. Wow, that is a massive all-in bet on one single industry. So, is this a brilliant move, getting ahead of the curve, or is it a totally reckless gamble that's ignoring some huge red flags? To answer that, we've got to understand the bull case, the argument for why today's sky-high prices aren't just justified, but might actually be a bargain. And it all boils down to two little letters, AI. See, the bulls, the optimists, they argue this isn't just another tech boom like the dot-com era. They see this as a civilization-level shift. Think Industrial Revolution big. The demand for AI isn't some passing fad. They believe it's becoming a fundamental part of the global economy. For every company out there, the choice is becoming really simple. Get on board or get left behind. And the proof? Well, you just have to follow the money. It is a full-blown corporate arms race out there. Tech giants are pouring hundreds of billions of dollars into AI infrastructure every single year. This isn't optional spending anymore. It's what they have to do just to stay in the game. And all that cash creates this huge, undeniable demand for the chips and the hardware that make AI tick. This right here, this really gets to the heart of the whole bull argument. They're basically saying that the old rulebook for valuing companies, you can just throw it out the window. In their view, the demand for AI is like breathing air. It's absolutely essential, and it is not going away. So it really makes you wonder, if the game has completely changed, shouldn't we have a new way of keeping score? But there's always a but, right? What if this whole AI boom is just a shiny distraction from a much, much bigger problem? That's what the bears are saying. They argue the real danger isn't that stocks are expensive, it's that the entire system has a hidden flaw, a crack in the foundation, created by the one thing we all thought was safe, passive index funds. This famous quote from Mark Twain just hits the nail on the head. It perfectly captures the bear case. The real danger isn't some complex thing you don't understand. No, it's in the thing you think is simple and true and totally safe, but actually isn't. And that leads us right to the core of this risk. They call this the seemingly correct fallacy. Here's the idea. For any single person, buying a simple, low-cost index fund is a no-brainer. It's the smart move. But what happens when millions and millions and millions of people all do the exact same smart thing? Well, the bears argue it creates this massive herd effect that's inflating a bubble right under our noses, hidden in plain sight. Okay, and this is where things get a little spooky. Some analysts, including Michael Burry from The Big Short, are seeing a chilling echo of the 2008 financial crisis. Remember that? Back then, the safe idea was that you could bundle a ton of risky mortgages together and, poof, they magically became super safe AAA-rated assets. Today, the safe idea is that if you just buy a fund that tracks the whole market, you're perfectly diversified. The bears argue the underlying flaw is exactly the same. In both cases, the price of the asset gets totally disconnected from its real fundamental value, and we all know how that ended in 2008. So, how does this actually happen? Well, it all comes down to how stocks get their price. The old school way was active price discovery. An investor does their homework on a company and decides what it's worth. But in a world run by passive funds, something different happens. When you put your money into an index fund, the fund just automatically buys the biggest stocks, no questions asked. So prices are being driven by the flow of money, not by whether a company is actually any good. It just becomes a giant popularity contest, and that can create a really dangerous feedback loop. Okay, so we've got two incredibly powerful stories, don't we? You've got the bull's civilization-level shift on one side, and the bear's passive paradox on the other. How in the world do we decide who's right? We need a referee. And in investing, the best referee is always long-term objective data. And, the data is telling a pretty scary story. This is the Shiller-Cape ratio. You can just think of it as a way to measure how expensive the whole stock market is compared to its long-term earnings. And right now, that number is sitting around 39. Now,
That might not sound like a lot, but listen to this. It has only been higher twice in modern history. The first time was right before the 1929 crash. The second was at the absolute peak of the dot-com bubble. Yeah, that's why some people are calling this a 5-alarm fire for the market.
Okay, so that data is pretty sobering. So what are you supposed to do? It feels like you're forced to choose between betting it all on a bubble or sitting on the sidelines and missing a revolution. But there might be a middle path, a strategy that's actually designed for this exact kind of uncertainty.
It's called the 80-20 core satellite strategy, and the idea is actually really simple. You keep 80% of your portfolio in your main investments, your core holdings, like an S&P 500 fund. That way, if the bulls are right and the market keeps ripping higher, you're still in the game. But, and this is the key, you build a 20% satellite position, a silver bullet of cash, as your insurance policy in case the bears are right.
So how do you actually do this? It's a simple 3-step plan. Step 1, and this is the most important part, do not touch your core 80%. No panic selling, no trying to time the market. Just let it ride. Step 2, you start building your 20% silver bullet. So every time you get new money to invest or you get a dividend payment, instead of reinvesting it, you just stick it in a cash account. You're not selling anything, you're just building up your war chest. And step 3, you wait. That cash is your secret weapon, ready to deploy when the market eventually takes a dive and everything goes on sale. So this really leaves us with one final critical question you have to ask yourself. In a market stretched to these historical extremes, what is more valuable to you? Having the conviction to ride the wave no matter what, or having the insurance to protect yourself if that wave comes crashing down? Look, we've really only scratched the surface here. If this got you thinking and you want to dive way deeper into this whole debate, I highly recommend you go check out the full episode on the Sip&Talk podcast. We've dropped a link to their show and to Micky's channel right down in the description below. Seriously, go check them out. Thanks so much for watching.